Hello. So today we'll be talking about a very fast growing company, especially in the space it is in, which is V2 Retail. So it is a small cap company and evidently in the retail segment. It sells mainly apparel. So it is gaining market share with leading growth. So how do I mean gaining market share? So first of all, gaining market share is very relative. And to explain how it is relative, let's take two players in the value fashion space. Let's say this is Trent, this is V2. Now, I know they don't really compete directly against each other because the segments are slightly different. Trent is a bit more premium than V2, at least as of now. So, when we look at these two, this is a very big player. Let's say the total market for both of these guys is 100 rupees of sales a year. So let's say Trent has like 95 and V2 has, let's say, just 5. And next year the market grows to 1, let's say it grows to 200, right? So when it grows to 200 next year, the market grew by 100%. And V2 retail, it relative to what it had earlier, it has, let's say, 20 rupees of sales. So Trent will obviously have 180. So even though Trent only lost a very small amount of market share to V2 in this scenario, V2 still gained very hugely. So that is what happens when you're a small player. So ideally, market leaders are, ones which are already pretty big. They're sizable a portion of the market, and when they just keep on gaining market share due to their, advantages of size, yeah, you tend to make some money. But when a very small player like V2 Retail comes in and just gains market share from a very big player, the market leader, that is Trent, for example. So that is the place where in relative terms, a lot more money can be made, right? And it does not take a lot because of the small base. But of course, these are also a bit high risk bets because a lot of times the market leader eventually wins. But till the time V2 grows faster than Trend, I don't think there's a very big issue with the company. So the main point is that the market leader is not always the one who's the biggest. It could be the number two, number three, number four player as well sometimes. And they just have to be gaining market share consistently, which V2, I think, has been gaining market share aggressively since the last 2 quarters. So V2 is not coming from a place of high expectations. So a year and a half ago, V2 was actually making losses. So this loss to profit is a very, very strong change. And so if something is priced for disaster, like V2 was, a small change, well, the change in V2 was actually quite large in the last year, but a small change can, make a big difference. But let's say a trend which was priced for perfection, when the reality hits of, okay, the expectations were maybe too high, then nothing can save these types of companies. Even though they're market leaders, they might not fall, but it just becomes very hard for them to make money. So that is why you'll see that, okay, in just a year and a half, V2 has already made like some over a 10x. So you might think that, okay, how much more can this do? But the situation back then and the perception of V2 retail was very, very, very negative. And it has just, started to become positive, let's say for a year. And that has shown in the price. And I think it will continue to show if the growth continues and the operating leverage continues. So why the change in margins is so drastic with this company? Just to understand that, so with revenue growth, they get a lot of inventory turn advantages. So let's say I have the shop and I have many clothes here. That is my inventory. Let's say I can turn this inventory like just twice a year on, let's say I have a 50% odd gross margin. So I make like just in simple terms, I make 100%, right? Because I do this twice a year, and I make 100% on my capital that I have invested. But a retailer that has a lot more demand, and as soon as the clothes come on the shelves, they're being taken out by people every season. If a retailer is able to turn their inventory, let's say 4 times, so for the same capital in the inventory that is stuck throughout the year, they can make like 200% margins. And a lot of this inventory turn gain does not include a lot of additional cost. You will still have the same days where the store is running. The employee cost should not go up a lot. Your employees will be busier, of course, but the cost should not go up a lot. The rent will not go up a lot, or at all, actually. So you just become very very profitable in this case compared to this case. You don't make just 100% extra gross margins. On the operational level, you make the operational profits will go up, let's say, by 3x, because of a lot of fixed costs that do not go up with this change. So this is exactly what is happening in V2, and it's also why Trent was getting such a big operating leverage. So there's no limit to this, right? If you can do this inventory turn, like let's say 6 times or 8 times, so you can become very, very, very profitable on the same capital invested. So far their inventory management has been top notch. I think that is the key factor. They're using a lot of, I think every retailer today, big retailer, will use some programs or some, tracking softwares to track their inventory, how it's being eaten up, and what do they need to replace the first, or not make more of. So because selling apparel is a cash business, they do not need to raise, and they're profitable now. They're pretty profitable now, so they don't need to raise a lot of capital to grow fast. So they even confirmed this in the con call that the growth they're planning, that can be done with internal accruals. So that is a very very important thing. So just to give you an example of the scale of the operating leverage they'll most likely get as per their guidance. So this year they should do around 70-75 crores of PAT, and next year this can double, only if their sales goes up by like 50%. So they'll go twice as fast in their bottom line as compared to the top line. They have guided for a very nice same store sales growth of 10%. So this is where the operating leverage kicks in very heavily, because all of this will not see a lot of costs go up, but of course the store rent and everything, that also goes up by some percent. So the fixed cost will go up, but I don't think as much as 10%. Most of their growth will actually come from new store additions. When you open a new store, that is usually not so good for your margins, at least in the short term, till the store matures a bit and you can make it very efficient. So the same store sales growth is a number which you track very closely to get an idea of the change in profitability, the change in margins, for example, because uh, just adding a lot of stores, it does not mean that okay, this change is going to happen. They might need more inventory, they might be able to turn it slower in the new stores. Anything can happen with the new stores. So they're adding 70 stores this year. They have already done a lot. They'll do like 20-25 more in the last quarter, this quarter, that is, from a base of 117. And they're planning 100 more in 2026. So already a major chunk of their revenue comes from private label, and I think they'll move it to just towards completely being private label. And that, I think, is a very very valuable thing, and the market should look at that change as well in a very positive light. So on revenue terms, this year they should do around 1,800 crores, and 2,700 FY26, assuming around a 50% growth. So you're getting this company at current prices for 5,250 crores of market cap. So FY25, it does not look very cheap, of course, but if the PAT actually doubles or close to doubles, I think they'll be around 35 times FY26 at current market cap. So for a consumer facing retailer, which is a private label, I think these valuations, the market should not value it this way unless it's a very very tough market. But over time, if it executes, I think the market should reward it even from here, eventually. So this is not financial advice. These are just my personal views, and this is like a documentation of what I think about certain things and how I think. It is not even made to influence anyone. If you have to, learn a thing or two from it, if you think it is useful, that is fine. So as always, based on the information that is available to me, it is a company doing very well. But in the future, it could turn out that it is not doing as well, or it could start, underperforming the peers, the sector, whatever. So in that case, it is not a good company. So it is the management that has guided for the store addition and the growth. It is not me. So these are not my personal thoughts entirely. So this was it. This is V2 Retail, and it is gaining market share aggressively. It is the leader in terms of growth. It is a very small player though, so the balance sheet is pretty strong as of now. I don't think they need to raise much capital as well to grow, but anything can happen with small caps or even large caps, I think. So uh, yeah, the picture looks good for now, at least relative to other players. So that's it. Thank you.